I was surprised by the drastic changes in the liberalized remittance scheme. There will be 20% TCS, the tax collection at source. This I think is a massive blow. When you invest 100 rupee and only 80 rupee is at work, this becomes very big disadvantage.
Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research.
I was surprised by the drastic changes in the liberalized remittance scheme. The liberalized remittance scheme was very simple. It was supposed to, it was liberalized. You don't have to go and seek any permission if you want to remit. If you want to invest or for any other purpose, remit $2.5 lakh. $2.5 lakh at current rate is nearly 2 crore rupee or little over 2 crore rupee. And that is the annual entitlement per person. So this was quite liberal. But now this has been taxed, and taxed in a very unusual way. Now there will be 20% TCS, the tax collection at source. So when you go to a bank and say that, okay, remit my 100 rupee to this person or this account, only 80 rupee will be sent and 20 rupee will be deposited with your PAN number in your tax account. You can take your refund. It's not tax per se, but it is tax collection at source. It is a deduction at source in the hope that, you will have something against which it will be adjusted. So you can take credit for that. So when you invest 100 rupee and only 80 rupee is at work, this becomes very big disadvantage. And for most investors, it actually was a big catalyst when Indian investors started investing abroad. It became a very prominent way of Indians investing abroad, and the fintechs and the digital banks, they actually played a very big catalyst role. There are broadly two ways of investing abroad. You invest in a domestic fund, and those funds are investing abroad. So you have a NASDAQ fund, you have a US opportunity fund, actively managed as well as passive funds available to Indian investors, and you put your money there and it automatically gets invested. And there is no restriction, nothing. There is some restriction from RBI for investment by mutual fund in such funds. And some funds have actually hit that ceiling. But still, many mutual funds have not hit their ceiling for their ETF allocation. So that is, still we have 2,400 crore which can be invested there. So that is still significant, and that is much simpler. You don't have to worry about anything. It will just be, it is like any other mutual fund investment. And here the international funds are treated as, the tax treatment is like that of a debt fund. Hold for 3 years, and then it will be taxed with indexation, or less than 3 years, if all gains will be treated as income, and you will be taxed at your slab rate. The big change that has happened is going to affect the direct investment. Today it was possible to open your brokerage account with Fidelity or Charles Schwab or E-Trade in America or anywhere else in the world. Remit your money to that account, fund that brokerage account with your money, and that 20% TCS is a big dampener, because this is actually a showstopper in the sense that who is going to invest 100 rupee and first deposit 20 rupee with the government, invest only 80 rupees? This I think is a massive blow. But this mutual fund investment, this continues, and that actually, so mutual funds have not become attractive, but they have become very attractive entirely because the other avenue has become completely unattractive. Investing abroad through mutual fund remains the simplest one. It will be treated as an investment, and the tax laws will apply. But you don't have to worry about first remitting that money, converting your rupee into dollar or whatever, and then sending it to the entity and buying all that. You don't have to worry about the TCS. This is the most tax efficient, most convenient. And if you want to set up your 5,000 rupee SIP, that is also very much possible. Because today many fund of funds are available which will accept that SIP. Besides that, they should invest abroad simply for the reason of their merit as well as meaningful diversification. Our jobs are here, all our investment is here. So there should be a part of my money which should be invested elsewhere. Besides that, there are compelling investment options, but there's a problem there too. Mutual funds also have a ceiling. RBI puts a ceiling of $7 billion for investing abroad through actively managed funds or other funds. And there is a separate $1 billion window available for open-end ETFs for investment in ETF. So that window is still available. And even there, the $7 billion which the mutual fund companies have hit in terms of the overall ceiling. But as and when they are witnessing some redemption, some funds are able to open the window for investments. So keep an eye on that. So that is making things little cumbersome. But if you want to invest in any of those ETFs, who have mounted a fund on top of those ETFs, start investing in that. That is the simplest and the most attractive way of investing abroad.
That's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.